Welcome back. You're still watching Closing Trades right here on 18R. Joy Rankothge, who's Vice President Moody's Investors Service, joins in for more details about how they are viewing the current macro environment in India. Joy, it's great to have you on the show. Thanks very much for taking out the time. You know, my first question to you essentially is India has low dependence on foreign currency debt and long average debt maturity. Do you see this containing the impact of rising rates and currency depreciation in India?
Thanks for having me. And yes, I think that's the crux of what we're saying in our report as well. That because India has a large domestic funding base for the government debt, and that the average debt profile is about 10 years, that broadly helps contain both debt affordability risks rising from rising yields, as well as implications from currency devaluation, because India only has around 4% of its government debt in foreign currency.
Right. Joy, the external debt to GDP is also higher than China, but far lower than other emerging markets, say, for instance, Brazil, Russia, Indonesia, or for that matter, Argentina and South Africa as well. Hence, do you see India being better placed versus emerging market and other Asian peers?
We have an indicator that we look at called the external vulnerability indicator, and that looks at how can a country, how can an economy service its near-term, so 1-year debt obligation against the foreign exchange reserves. And as you know, India's foreign exchange reserves, for example, compared to 2013, are significantly high, and even though they are off on a near record, they still remain quite substantial. So from that EVI indicator, we assess that India's external vulnerability risks are quite low, and that its external risks are quite contained.
Right. Emerging markets and Asian peers, are seeing a bit more pressure than India. Could you give us a sense on the key factors that Moody's will watch out for Indian macros, and also more importantly, the move on sovereign ratings?
Yes, so from a macro GDP standpoint, we just released a global macro forecast just a few days ago. And in that, what we're saying is that for India, we're expecting quite robust growth, around 7.5% for this year and next. And that's the ongoing cyclical recovery, as well as we don't see the headwinds from high oil prices or rising interest rates as having a significant dampening effect on the macro economy, and also that pre-election spending will likely act as a buffer in the near term to any downside that we might see. So from a growth standpoint, I think we are expecting quite robust growth. From a rating standpoint, as we had published earlier this year in our credit opinion on the sovereign rating, the risks are balanced, as we see downside and upside risks are balanced, and that's why we have a stable outlook on the sovereign rating.
What about internal factors, Joy, though, like twin deficit, fiscal deficit, current account versus what the peers have been quoting at? Because that seems to be picking up higher thanks to oil prices.
So yeah, a couple of points there. I think on the fiscal front, what we're saying is that in the short term, we are seeing rising pressure, rising risks that the government's fiscal targets for this year, for meeting those fiscal targets for this year, partly because of high oil prices, but also due to certain recent changes. For example, the GST cuts that were implemented in late July, the tax cuts for the small businesses, and also the relatively elevated MSP formula that was released, as well as social spending, pre-election spending. So all those factors adding upward pressure on expenditure. We expect the government to likely try to limit the slippage, as done in previous years through cutbacks in capital expenditure. But I think the risk is that those cutbacks may not be sufficient. So at this point, we see a risk in meeting the fiscal targets. But at this, having said that, I think our view is also that even if at all there is slippage, the growth momentum remains quite strong. As I mentioned, 7.5 growth we're expecting, which is and nominal growth quite strong as well, which is an important factor in India's debt affordability, as well as the point we brought up earlier about most of the debt being domestically funded and sourced and being in the local currency, which again kind of helps debt affordability. And in terms of the current account, because of the oil dynamics, as well as I think strong growth again, we see that including rising imports, a strong demand for imports, the current account deficit we are projecting will be around 2.5 or a little bit higher this year. And those pressures will continue to be there because of, and again, our expectation for oil prices is that they'll remain at these levels around 70, 72, that range bound for this year and next year for Brent, and then start to decline somewhat. And the current account deficits will be financed through FDI, portfolio flow, as well as a last resort on foreign exchange reserve management, given that India has quite substantial foreign exchange reserves.
Those detailed analysis of how you're looking at the macro environment in India and how you're correlating that with how Moody's views India's investment grade currently.